Now, Tony Bell, CIO of Vunani Fund Managers, joins us now for a look at the outlook for the global macro environment, as well as some of his top picks for both local and global stocks. Tony, I just want to get your thoughts before we go to the global environment on the Rand. It's dominated much of the conversation on the news desk today. It is obviously buffered by the international currencies when it comes to the crosses, but just your thoughts before we go into a broader conversation.
Indeed, Bronwyn, hi. Good evening to everybody. My thoughts on the Rand is that it is going to be structurally weak for a little while to come. As most of your commentators have pointed out, the headwinds facing the Rand are quite substantial. We've got some local structural issues. We've also got some drag effects from things like delayed inflation coming through, and we've got a lot of action in international bond and currency markets which cross over into the Rand. So I'm afraid the news in the very short term is likely to be weaker for a while longer.
But Tony, let's have a look at the Rand now and the effect. I mean, what people say to me always that the biggest effect, the biggest influence in the inflation equation in South Africa is the South African Rand, the rate of the South African Rand against the dollar, against the euro, against the British pound. We haven't got really any inflation. We've got 5.4%, 5.5%. It's been there for ages, and the Rand's gone from 8 to 11.20.
Sure.
There's no demand in the system. That's why the Rand, that's why the inflation rate rather is not doing anything. So why should we worry about the Rand?
Yeah, Lindsay, it's an interesting question. We've done a lot of analysis on it over the last few weeks, and what we find as evidence from the recent retailer results is that there's been a lot of cost absorption into the equation. So if you have a look at a company like Truworths, for example, same store-on-store sales is only up 1%. And the folk are having to absorb a lot of those costs to keep prices attractive for consumers, specifically because the final demand has been very weak. So as consumer demand weakens, retailers and other businesses in South Africa have had to really become quite innovative in pricing their product in order to get the volume growth.
So this means then, this implies then that margins for retailers are going to come down, and I know David Shapiro and Viv Govender will be interested in this. I don't know about you, David, but if the retailers can't pass on the price increases, then obviously the retailers' margins go down, and therefore the retail stocks come down on the JSE. Would you not agree?
I absolutely agree, and I think the big thing that worries me as we see this happening is that the multiples are still far too high to justify the kind of results that they will produce. And you can see it already in some of the companies that we were reporting today, Cashbuild, PPC. You can't give those kind of results, produce those results, and expect your share price to hold its current levels. There has to be that re-rating downwards.
Indeed. Tony, what do you think about that? I mean, he's talked about two completely different companies, but in a certain way they're linked, PPC and Cashbuild. But we've also seen some fairly ghastly numbers coming out from a couple of the more bigger sort of high street names, if you like. What are the implications for the retail stocks, and what are your top picks, if you have any, within that sector?
Lindsay, we're quite light on the retail sector as a whole. The only stock that we really hold in the portfolio is Woolworths, because we think the high-end consumer is able to protect their purchasing power, and that will keep some underlying margin coming through to Woolworths. But a broader answer to your question, which also came up in the recent analysis, was that if you look at the lagged effect between the JSE's overall earnings and forward PEs, the market sort of discounts forward earnings by about 13 months. And if you have a look at the recent price move that we had up into December, it was really largely PE driven. So in simple terms, the market has anticipated forward earnings coming through, and if those earnings momentum slow, we would see some vulnerability in the PE and the whole market coming down.
David, back to you.
Tony, I regard Tony as one of the top strategists in the country, and I'm exposed to him quite a lot and always enjoy his views. And for that reason, I'm going to ask him a question which I want a straight answer. Tony, if you were Jill Marcus, what would you do? How would you handle the current situation in the country now, with the Rand where it is, and of course with inflation coming through? What would you say on Wednesday or Thursday?
Okay. Dave, I think that question has a slightly deeper answer to it, and a very brief response. I think the US itself is going to experience lower inflation, not higher inflation this year. I think the Fed is probably going to start changing its narrative towards guiding the market away from tapering and focusing on its mandate, which is core inflation. I think that will settle the market somewhat in terms of an unexpected growth shock in the US, leading to earlier tightening on the top of tapering. And I think paradoxically that will give Jill Marcus some sort of lead time into the environment that she's busy operating, which is fraught with difficulty. If you look at the tone of the SARB over the last while, it's become increasingly dovish. The tone of the statements have become even slightly alarmist. So there's very little policy maneuvering available to her other than raising interest rates, which in this economy would be very, very poor for growth. So I think the macro environment really needs to come to the fore in terms of weak international inflationary pressures, giving some sort of respite through to central banks that rates won't have to be tightened in the immediate future. And if Europe and the rest of the world does start to grow, we could see some sort of tailwinds for the rand, which would take off some of the pressure she's currently sitting with. But it's a very difficult position she's in.
Tough job for Jill Marcus. Viv Govender, what have you got to say about this?
Yes, I most certainly don't believe that we have an economy that's strong enough to basically justify rate hikes at the moment. But that being said, of course, inflation may become a problem down the line. There's a bit of a lag between the time we see the currency weaken and actually inflation will come through the market. But looking more specifically at the market at the moment, I know you've mentioned the fact that you are quite light on retailers. Where do you see any value in this market right now? Are there any sectors that you think are still reasonably value or even cheap?
In the South African market?
Yes.
I think a lot of the diversified industrials with international exposure, driven obviously by the weaker rand, have a very strong tailwind behind them. And then I think one also has to look a little bit deeper in the market. Some of the stocks that were really hammered hard last year, companies like Able, are sitting on very low single-digit PEs and could actually paradoxically provide a little bit of protection in this environment against other stocks, dare I mention it, Naspers on a historic PE of 60.
Tony, let's go back to the international environment. I see you've been watching that Fed carefully, and you think that the conversation there is going to move away from tapering to focus on inflation and growth effectively, which I assume the core mandate.
Bronwyn, yes, it's a slightly contrary view. If you had to try and describe the general view out in the marketplace at the moment, certainly up until a few weeks ago, it was that the US 10-year Treasury would rise, probably to about 3 to 3.5%. The gap between the 30-year Treasury and the 10-year Treasury is at the highest level in many, many years, at about 120 basis points. And the market generally assumed that because the Fed was tapering, and because the US economy was starting to grow very well, even as Stephen said on your prior show, that inflation would be a consequence. We don't see that for three very key reasons. The savings pool is still quite large. Businesses are not investing and they're sitting on huge amounts of cash. And governments aren't introducing any new forms of expenditure. So we find the predominant force in the US economy to be deflationary, not inflationary. And if the Fed wants to change the narrative in an environment where inflation does fall and the US Treasury comes down, and indeed the 30-year US bond comes down, that will provide the market with some relief that in fact tightening is not imminent, and that will anchor the PE multiple of the S&P 500, which is not really that demanding at 15, in an environment where the market otherwise would have responded negatively to the prospect of higher inflation.
This is music to David Shapiro's ears, of course, because he wants the interest rates to be incredibly low for a lot longer, and inflation to be low as well. And it looks as though we're going to see that. David, you must be jumping through hoops at the moment.
I love
just mopping up the S&P, which is down 12 at the moment.
And the best thing that Tony said is that 30-year rate is going to start coming down. In other words, the 10 will stay where it is. Once that 30-year rate comes down, that means that mortgages become more affordable, housing picks up, and so on. So yeah, you did right. I like what Tony says, and if there is, if there's no inflation, of course that's going to mean it's going to be very good for stock markets.
Lindsay, final question from you in Cape Town.
Final question from me in Cape Town is, should I buy or sell the market? This is a really tricky and sophisticated question. Tony Bell.
Lindsay, I would be more favoured towards buying overseas markets. The PEs are lower. The earnings diversification is greater. South Africa, I'd be very selective. The markets run hard, and I think some stocks are going to struggle to meet the growth rates that are implied in the current prices.
Okay, I have to ask you exactly what you mean by that. Be selective. I mean, that's a sort of a broad statement. Be selective to us.
Stick to companies that can maintain their earnings power, and that's largely companies that have got businesses outside of South Africa and are driven by consumer demand that remains robust in those areas.